everyone and welcome to today's Market Snapshot. My name is Craig Erlam, Senior Market Analyst at OANDA. Now today there's really been three things that I think people have been primarily focused on. The first is the aftermath of yesterday's ECB decision, still weighing on European equity markets as we speak, and just to touch on this announcement, because there was no video yesterday, there wasn't really anything announced at all. In fact, the ECB did even less than people were anticipating. I think markets were expecting potentially some more QE or another rate cut or some further stimulus, but at the very least they were expecting the ECB to extend the quantitative easing program beyond the current deadline, which is March of next year. The issues that the ECB faces with this, though, is the availability of government debt that it can purchase under the current structure. At the moment, there's a lot of rules prohibiting it from purchasing more than 33% of any debt issuance. The proportionality of the bond buying as well is an issue. It works out, I think, around 25% of all purchases must be German debt because of the size of the economy relative to the other economies in the euro area, and it seems that they are now being limited by the availability of qualifying German debt. So this is the first issue that they're going to have to face. They did touch on the fact that this is something that they are looking into at the moment. They didn't discuss extending the program, which is clearly because they're looking at ways which they can buy more debt before they look to increase it, which makes sense. So I think really, while markets were caught off guard by the lack of action by the ECB, I don't necessarily think it's too big a shock. Inflation and growth was both revised slightly lower, but much less so than you'd previously have anticipated after the Brexit vote. I think people thought that the vote would have weighed more on the European economy than it has done, but that's true also of the UK economy as well. So it just we haven't seen the initial shock to economic growth or inflation in the eurozone from the eurozone's perspective that people were previously anticipating. So you've got to question whether the ECB really needs to do further stimulus at this stage as a result of that vote. So nothing much came from the ECB yesterday. I think it is hitting stock markets today because I think markets were potentially badly positioned. And the other reason why I think markets have potentially overreacted to this is because just because they haven't extended QE, it doesn't mean they're not going to. I think it's very, very likely that the ECB will find a way to push back the deadline for QE probably by another 6 to 12 months at this stage. They just need to make sure that there is enough qualifying debt out there before they can do so. So whether it's now or December or March, it doesn't really make a difference. It is very likely to happen, and I think the markets will adjust accordingly. The other thing that I think people are focused on today is the oil markets. Yesterday we saw the EIA number, which more than confirmed the API data from Wednesday, showing around a 12 million drawdown in crude oil stocks on the week. That's the biggest drawdown since 1999, and it really did create a spike in oil that we started on Wednesday when we saw the API number, which was around 10 or 11 million, and it did then push on high. We saw Brent crude actually push through $50 a barrel briefly before pairing its gains. It's down around 2% today, but I do think this is a pairing of this week's gains as opposed to any negativity around crude. I do think we could potentially see some further upside in the coming sessions. I think this all started with the cooperation between Saudi Arabia and Russia, which didn't really come to anything, and I don't think the markets are buying it too much. It potentially leaves the door open to an output freeze down the road, but that provided a boost to prices, and now I think this massive drawdown in stocks has provided that catalyst for the next move higher. I think it's worth noting that this massive drawdown, it does look as though there were temporary factors behind the drawdown. I wouldn't expect there to be another drawdown quite that size next week. In fact, we could see a large build instead, and it'll be interesting to see that because I just don't think there's any sustainability in drawdowns in general, let alone ones of that magnitude. It does bring into focus though today's oil rig count data from Baker Hughes. We have seen oil rigs. The number of oil rigs in operation rise quite significantly over, rise quite considerably since I think it's late May when they appeared to bottom out. I think they're just over 400 at the moment, but they do seem to be stabilising a little bit at the moment. Should we see a reduction in the oil rig count today, that may just add to the bullish story for oil and give it that next leg higher. So it'll be interesting to see how oil does end the trading session. The final story today does relate to one of the key economic events today, and that's with relation to the Fed. Now, let me bring up the economic calendar to show you here. We've had some data out today, but it's been a very low data session, really. The more decent news for the UK. Inflation expectations a little bit higher, above what the ECB's, the Bank of England's target would be. Better trade balance figures. Improving trade balance figures, even though they are slightly worse than expected. And we also had some employment data from Canada. The key thing for me, though, one of which is noted on the speech from Eric Rosengren, who is a voting member of the FOMC. We've also got two other speeches today to come. That's Daniel Tarullo, who's due to speak on CNBC, and Robert Kaplan. Now, the importance of this is Daniel Tarullo is a permanent voting member of the FOMC. Robert Kaplan isn't a voting member this year, but it means we've got two voting members speaking today. We had some hawkish commentary yesterday from one Fed official. This comes on following a number of quite bullish comments from different Fed officials around the Jackson Hole event. Now, Eric Rosengren is typically quite a dovish policymaker among the Fed, and the comments today that we've had from him would suggest that a rate hike is just around the corner, suggesting that the labour market could well exceed full employment next year, that gradual policy tightening is likely to be appropriate, and the current policy increases the chance of overheating, which I think is maybe a bit of a strange comment, given that growth in the economy is very low at the minute. So talking about overheating, I think is going to confuse a few people. But he also sees risks to overshooting on economic growth as well. So maybe these comments maybe are going to confuse people a little bit. But for a dovish member of the FOMC to be making these kind of comments and making these kind of noises would be seen as quite a hawkish thing, and would suggest that we are going to see a rate hike this year. He doesn't necessarily mention the September meeting specifically, which makes me again think that it's more likely to come in December than it is in September. It'll be interesting to see again what Tarullo and Kaplan have to say on this matter as well, if we get more hawkish comments from them, and if either of them really allude to this September meeting as being live or being likely, then I think we could see more of a reaction in the markets. But I think what people want to hear from now is some of more people like Tarullo, some of the more permanent members of the Federal Reserve of the FOMC, Janet Yellen, Stanley Fischer, William Dudley, etc. And then that could potentially put September on the table. But at 18% implied probability in the markets, September does seem very unlikely to me at this stage. I think everything does at this point to a rate hike in December. For more in-depth news and analysis, check out OANDA MarketPulse at marketpulse.com. You can also find out more about OANDA and sign up for a free demo account at oanda.com. Here you'll also get access to OANDA Forex Labs, which has a lot of great tools designed to help you with your trading.